Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today, we're diving into a fresh 8K report from Applied Materials. Don't worry, it's not about kitchen appliances, though this report does involve a lot of application of financial strategy. We're going to look at how Applied Materials just locked in a big financial move that could really shape their future. This report is dated February 24, 2025. That means it's covering events that happened right around that time. The Form 8K that we're looking at is basically a snapshot of big news that a company needs to tell its investors about quickly. Think of it as a business alert. The big story here, Applied Materials just signed a new credit agreement. It's a formal deal, so something very important and real, with several banks for a whopping $2 billion revolving credit facility. Now, what does that mean in plain English? It's like getting a $2 billion credit card. They can borrow money up to that limit, pay it back, and borrow again as needed. This agreement is with Bank of America and other lending banks who are part of the deal. This new credit agreement replaces an older one from February 2020. The previous credit agreement was for $1.5 billion, so this is an increase in available credit for Applied Materials. The company can borrow up to $2 billion at any one time. Within this agreement, there's also a side agreement allowing them to issue letters of credit up to $400 million. Letters of credit are like guarantees that Applied Materials can pay its suppliers. There's also a chance for Applied to increase the total credit available to $2.5 billion. Now let's talk about interest. The interest rate on these borrowings can either be based on something called the Secured Overnight Financing Rate plus an adjustment of 0.10%, or it can be based on the highest of a few different rates, including the federal funds rate, the prime rate, and term SOFR for a 1-month interest period plus 1.0%. The exact rate depends on the company's credit ratings, but it will range between 0.50% to 1.00%. It is also worth noting that Applied has to pay fees on the unused portions of the credit. This credit agreement also comes with some rules. These are standard for these types of deals. One financial rule is that Applied needs to maintain a certain ratio of earnings before interest, taxes, depreciation, and amortization (EBITDA) to net interest expense. Basically, their profits need to be at least 3 times their interest payments. If Applied fails to meet these rules, it could trigger what's called an event of default. What's this money for? General corporate purposes. This can mean anything from funding operations, acquisitions, or even buying back stock. The credit agreement is set to mature in February 2030. So, Applied Materials has until then to repay any outstanding loans under this agreement. There's a lot more detail in the actual credit agreement document which has been added to the exhibit. This document is where all the specific terms and conditions are laid out. It's worth noting that the banks lending the money also do other business with Applied Materials. This is common. These banks have likely earned and may continue to earn fees from Applied for other financial services. Now let's switch gears. Because Applied Materials has this new credit agreement, they terminated the previous one. This prior agreement was from February 2020 and was set to expire in February 2026. Good news, there were no outstanding debts on the previous credit agreement. This means Applied Materials isn't carrying any debt from that older arrangement. Applied Materials has taken on a new financial obligation with this credit agreement. Even though they haven't borrowed any money yet, the fact that they now have access to this credit line affects their financial standing. The exhibits mentioned here provide all the backup to what we've been talking about, particularly the full text of the new credit agreement.